Hello, welcome to Passive Investing Made Simple Investor Masterclass. My name is Chad Zdenek, sitting in for Whitney. Super excited to be able to do that for her. She's off on vacation. So, welcome aboard. Excited for this week's topic. And if you'd like, please go ahead and let us know in the chat where you're calling in from. It's always fun to see where folks are calling in from. All right, we're letting people in here. Welcome, welcome. Passive Investing Made Simple, Investor Masterclass. Again, my name is Chad Zdenek, sitting in for Whitney. She's on vacation. So go ahead and let us know where you're calling in from. Love to see folks from all over the country. I see we've got Texas, got Los Angeles. Where else? Where else are people coming in from? All right, another DFW, Texas. I'm actually flying out there day after tomorrow, heading out to a conference out in Dallas um, with the real estate guys. Not sure if anyone's headed to that one or not, but I will be out there. Paul, welcome aboard. All right, looking good. So we got some people trickling in here. We'll start here in about 30 seconds. Just looking to see where everyone's calling in from. So far, Texas is in the lead. It's always Texas, isn't it? I'm actually heading out there day after tomorrow out to a conference in Dallas, real estate guys in Dallas, actually. So flying into DFW. All right, another person from LA, Massachusetts. All right, just about every time zone represented. If Whitney was here, we would have every time zone represented. All right, well, let's go ahead and get started. Super excited to be talking about this topic today. We're going to be going over investing with co-GPs, what every LP needs to know before committing capital. This is a big topic. There's lots of different structures out there, and excited just to go over this with you and kind of share some of my experiences in different roles. So if you'd like, if any questions pop up, feel free to pop them into the Q&A box. I'll be checking that at the end of the presentation. Um, and Q&A or chat, I'll be looking at both of those. Q&A is easier if you see that one there. But yeah, let me know what questions you might have. We'll be going over it. So let's go ahead and get started. So the objectives for today, we're going to be learning the key differences between lead GPs, co-GPs, and LPs, and why that matters for your investments. Lots of different ways to invest, but it does make a really big difference. And there's pros and cons to it, as you might imagine. So I'll be going over that and also be sharing some firsthand experiences of what can go right and what can go wrong. So lots of lessons learned there as well that I'd like to share with you. So we'll also find out, okay, so how do co-GPs impact your returns? Risk exposure and transparency, very, very important from the limited partner perspective. Because if you don't see what's going on, it's very difficult to know what's going on with your investment. So that's going to be key. We'll talk about that. And then finally, I'm going to give you a 5-step due diligence framework to vet syndications and avoid mistakes. And again, I'll go over some of the issues I've seen over the years, and hopefully you can avoid some of the pitfalls. Just to introduce myself, my name's Chad Zdenek, and I'm the co-GP or GP in $150 million worth of multifamily and self-storage properties. I'm invested in 22 properties across 5 different states with 4 different operators. So I think it's a pretty good background there of experience Can share the good and the bad, the ugly with different things that I've seen. I'm a licensed general contractor and professional engineer. And then finally, here at PassiveInvesting.com, I'm the manager of strategic investor partnerships. So I actually manage the co-GPs that we have on our debt fund. So we have an evergreen fund. It's a $100 million debt fund that we have, and we partner with co-GPs on that. So I manage that part of the program for the business, as well as investor relations for the Western US. So, yes, I'm a father of five. I have four daughters and a son. So, when I'm not out traveling different conferences and doing all things real estate, trying to keep my head on straight with a big family here in Los Angeles, pretty active bunch. So, that's a little bit about me. So let's talk a little bit about why this matters to you. And I know that we're going to have folks from different backgrounds on here. So this is the investor masterclass, but I'm going to be talking a fair amount about GPs and co-GPs. And I know we often get operators in here or GPs that are also listening on the class. So I'll be talking about that as well. But it will be emphasized mostly on from the investor mindset. But if you are a co-GP listening in on this, it's important to know, because what are your investors worried about, right? What are their concerns? You need to be able to address these concerns in order to have a successful deal. So obviously, a great GP team can have a high-performing, well-managed deal, strong communications and returns, and that's what we're all going for. And that's how it always starts out, but it's not always how it always ends up. So that's what we're here to learn about. On the flip side, a poorly structured GP team can have mismanagement, poor execution, and most importantly, risk to your capital. So we're going to be going over those sort of things to find out why it really matters to you as an investor. So before we dive into that, I did want to kind of get the semantics out of the way, just so we have a clear understanding of what we're referring to. And basically, we're going to be identifying the LP as the limited partner, right? This is traditionally the people that are providing the equity, along with the GP. GPs oftentimes will contribute their own capital in an LP position. I believe it's a red flag if they don't. So you really do want to make sure that they're truly investing alongside of you in the LP class of shares. The general partners, now those are going to be the active investors, basically are running the show, right? They source the deal, they put the structure together, they manage everything. You might have also heard the GP referred to as the sponsor or the operator. Those terms can be used interchangeably for the sake of this presentation. I'm going to refer to it as GP. And then you've got the co-GPs, right? These work alongside the lead GP, and they share different roles, right? Capital raising, investor relations, asset management. There's other things they could do, loan guarantors, for instance, yeah, sourcing the deals, wholesaling the deals, brokering deals, right? Brokers can come alongside as co-GP. So there's lots of different things that a co-GP can do. So this is just like the universal term for someone else who's helping out the sponsor, right? We're going to call them the co-GP. What I'd like to see in the chat is, let me know if you're an LP, a GP, or a co-GP, or all of the above. Like for me, as an example, I would be in all three of these categories. So let me know which roles you're in. I'm just curious to see the background for folks. Um, let's see. So we got LPs, co-GP and LPs. Okay. So we do have a lot of LPs in here, and a few co-GPs. Not sure if we have any of the other operators, aspiring co-GPs. Okay, so yeah, lot of folks from different backgrounds, which is great, because I wanted to talk about this. Again, we're emphasizing from the perspective of the LP, but it's very important to take a look at this. If you are a GP or co-GP, look at it from their perspective. So I think this will be valuable for a lot of different folks. All right, so let's take a look here. And let's talk about the relationships between the GP and co-GP, right? Because this is going to affect a lot about your investment, right? It's going to affect your cash flow, it'll affect your risk level, and it's going to affect the transparency and communication. Now, this is an example of where a true team can make things better. And I'm going to go into that a little bit on my experience on how I've worked with co-GPs that have made the ultimate investment a better deal than it would if it would just been a single operator. And also go over situations where there's too many co-GPs and it became a problem during certain points of the deal. So it can go either way, and it's critical to take a look at each of these. So let's go into these scenarios a little bit, right? So a bad scenario would be if your co-GPs are only raising capital and don't really contribute to the execution. Unfortunately, this is a bit too common in this industry. You might have heard of them, call it capital raisers. But some people use that term interchangeably with co-GP, and that's a pet peeve of mine because co-GPs should and can do a lot more than capital raising. In fact, the SEC does not want co-GPs to be compensated only on capital raising unless they're a broker dealer. That's another story for another presentation. But suffice it to say that co-GPs should be doing more than just raising capital. And that's what you want to really make sure. Good scenarios is that they're actually bringing more to the table. So I'll share a quick story on a success story that I was involved in on a small team. So we had four of us GPs or there's one GP and four co-GPs, right? And out of that team, we had one co-GP who was primarily doing investor relations. She spearheaded that. We had one co-GP who was an ex-CPA, and he headed up like the underwriting side of things. My background in that deal as a co-GP was on the construction rehab side of things, using my background in construction engineering. And then we had two that were the lead GPs or the operators, right? And they were the boots on the ground in the location where we were buying these deals. We'd bought 7 properties in a fund, and so those two GPs were the ones that were managing the on the boots ground type of stuff. So you could see just from that example that with those 5 backgrounds of all of us, that wound up being and is a what I would say a good scenario, right? We each have our strengths. We have clearly defined roles, which I'll get into in a little bit, so we know what each others are doing, and the sum of what's the saying? The sum is greater than the sum of the parts, right? The whole is greater than the sum of the parts. So each of us contributed to a pretty successful fund. That was a $6 million raise, just as an FYI, with 7 properties. Take that on the flip side now, a bad scenario. I was also involved in a deal as a co-GP, and we had a lot of chefs in the kitchen on this one. We had probably about a dozen co-GPs, and these were primarily capital raisers, investor relations, some asset management, but it was a lot of people to manage. And it's not so much of it's not necessarily a bad issue if things are going well, right? Um, as long as things are going well and the market's doing well, the property's doing well, it's not that big of a deal. But you might have heard the analogy of the horse race analogy, right? Where the jockey is the operator, the horse is known as the property, and the track itself is the market, right? And the common phrase is that you want to bet on the jockey, and that's true in real estate too. You want to be betting on the operator. But I also like to say that there's a fourth player in the race, and those are the stable caretakers. I'd like to refer to as the co-GPs who focus on investor relations and capital raising. Those are the stable caretakers, and they become critical when there's an issue, when the horse becomes sick, right? When the property's having problems, and you need to take care of the property and basically all hands on deck to do that. That can become a problem if your your stable caretakers aren't all aligned with what needs to get done for the horse. And I experienced this firsthand on a deal when we had to go through a capital call, and these people that were in charge of investor relations for the respective areas weren't carrying their own weight. And there was not a lot of communication from some of these co-GPs. There wasn't the transparency to their respective folks, investors. And when we needed to do the capital call, there was a huge difference between who was bringing money and who wasn't bringing money. And it became really apparent and glaring when I looked back and saw like how successful the capital call was. Like I had brought like 80% of my investors participated in the capital call, right? I would say that was a success. I was happy with that. It was a lot of work, but I was happy with that. The average of these other co-GPs was 20%. And it's like, how can you get a deal across the finish line, a capital call a deal across the finish line, when you only have other co-GPs that are bringing 20% success rate to the capital call? You can't. That horse is going to be sick for a while, right? And that was a major, major problem. And frankly, I learned the hard way about the challenge of having too many co-GPs on a deal, right? Too many chefs in the kitchen, as they might say. Very, very difficult to manage. So there is a sweet spot, I think. And I've done it as a one-man operator too. I've been the sole GP, right? Where there are no other co-GPs. And then I've been on another, like the deal I just talked about, where we had 12 co-GPs, right? So that's a huge range, and I've had things in between. And in my experience, there is a sweet spot, right? Unless you're a really large operator and you have everything in house, I think those can be very successful single operator roles also. But when you say single operator, they have a team that is doing everything under that operations umbrella, right? Very, very important. PassiveInvesting.com has grown to that type of scale where we can be a single operator, and I would say do things very successfully as a single operator. We do have some deals that we bring on co-GPs, not quite as much as we did before, but you just have to be careful to know what that experience level is. I will share that myself as a single operator, um, it was a ton of work to do that, right? I did everything from A to Z. And it would have been a bit more manageable if I had had other people to help me out in certain areas. I wouldn't have had to do everything myself. So I do think there's a sweet spot. Most folks will tell you that it might be 3 to 5 co-GPs, unless you're a large operator and you do everything under your own roof, then that would be the exception to that rule. So let's continue about some key questions, right? There's tons of investment opportunities out there, even in this current market. Some will say some of the best opportunities are happening right now, right? When there's blood in the streets, as I believe it was Warren Buffett said. Um, so what are the questions that LP should be asking, right? So as you can tell, you really want to dive into who is making up the team, right? And you can start at the top. That's always a good thing to do, start at the top. But you want to go down a next layer and find out who else is partnering on the team, right? And then what are their roles that they're doing? And how are things divided up? Because you really want to be making sure that it's pretty clear who's doing what. That's going to make for a stronger team down the road, right? Are these other partners that are a part of the deal, what is their expertise, right? Or are they just primarily bringing in capital? This is something that you want to be cognizant of, right? And ask these questions to go down the road, and then you can do a little bit of background on those other partners to find out what their experience level is, right? Do they really have the experience, or are they new to syndications, right? Everyone's got to start somewhere. So I'm not trying to say if there's a new syndicator to avoid it altogether. If they're a new syndicator at the top, you really want to do your homework to make sure that they know what they're doing. And that's going to be difficult for that particular person. But we all start somewhere, right? So it's not necessarily a red flag, but you just want to know if it's a whole team of new syndicators, I would say that's a red flag. But you want to find out what their experience level is, right? So let's talk a little bit more about advantages of investing in these deals with co-GPs. Like I mentioned, as a small single operator, there are advantages to bringing on other people to help out with the expertise, right? Here you go. More expertise can help out. In that previous example I gave to you, where we had me as the contractor, we had a CPA, we had an operator with the boots on the ground, and we had a heavy IR person, right? Like that was a pretty solid team, and the fund's done well. Um, Better risk management, right? Like I said, when the horse gets sick, and it's usually he's going to get sick at some point, right? It doesn't need to be capital call sick, but there's going to be issues that come up. And if you have different people with different backgrounds, right, that's going to help manage the risk. And this is really critical for you as an LP. Stronger investor relations, right? If you have, let's say you have a decision to make on whether you're investing directly with the operator or through a co-GP that you know really well. If you have a really strong relationship with a co-GP, they can be a great voice for you in the deal, right? They're going to be pooling people together. It could be a fund of funds model too. We haven't really talked about that, but it could be a fund of funds model. But they're basically helping to manage this pool of people and bringing a pool of people into a larger deal. And if you have a great relationship with that co-GP, they can be a great voice for you. And so you have your main operator or sponsor at the top who's talking with and working with these different co-GPs. And in these really large deals, that co-GP could be a really good voice for you, right? So that can actually be a benefit. Now let's talk about some of the disadvantages, right? We went into this a little bit in terms of when the horse gets sick. Misaligned incentives, right? So if your if your co-GP is only getting money on the front end, there's not a whole lot of motivation for them to see your deal through. This can be a major issue. If they're not, if they're not investing alongside with you as an LP, if they're not getting compensated along the course of the deal through asset management fees or maybe a disposition fee at the end or property management they could be helping out with, right? Then they could be just going on for the next deal, right? Leaving your deal behind, let someone else deal with that, and just moving on to the next. That's a common issue in our industry, so you got to be careful of that. Less transparency, right? If your co-GP or the person that you know well, if they're not staying plugged into the deal, they're not going to be able to communicate with you what's going on. So that can be an issue, right? Because they have to hear about what's going on from the sponsor if they're not actively involved, and that could be a challenge. And then finally, potential dilution of GP responsibilities. Again, you want to make sure you have clear delineation on who's doing what. That's going to be pretty critical to avoid issues down the road. So let's talk about the incentives a little bit. I gave a master class about 3 weeks ago on going from LP to co-GP, right? And I talked a lot about the different ways you get paid an amount. I'm not going to go into the details now, but if you are interested in that, particularly if you're a co-GP and want to find out how people are getting paid, or if you're an LP and you want to know about what's typically done in terms of compensation, I would check out that last master class because I went into the details quite a bit on that. But let's just brush the surface here and talk about how these co-GPs are getting paid, right? It's going to come from the GP side of the equation, right? So that you have asset management fees, you got property management fees, acquisition fees, disposition fees. So those are the main ones. You don't have to necessarily have all of them, and they can vary quite a bit. But those are the fees that are getting charged to the deals. And then you have the promote or the split, the GP LP split, right? Typically, like what we do at passiveinvesting.com is typically a 70-30 split where the LPs are going to have 70% ownership of the equity, and the GP team is going to have 30%. Now, that does not include the LP investments that we make as GPs, right? We invest in all of our deals, and we're open and we're transparent about what that amount is, so that you know. I would consider it a red flag if the GP is not investing in the deal as an LP. I would consider that a red flag. You really want to make sure that they're truly aligned and have skin in the game at the same level as what you have, as an LP. Also, if you have too many GPs that are added, that can get difficult, as we kind of talked a little bit about, more so when things start to go wrong. I can't remember who came up with it, but they say when the tide goes out, you find out who's swimming without shorts on, right? So when things are healthy and things are going right, it's not as big of an issue. You really start to see problems with structures and co-GP teams and stuff like that when things are challenging, right? And it's not to say that to avoid it. It's just to understand how it's really done, and how things are structured, where your equity is going to sit, in case something does not go according to plan. There's always issues. Believe me, there's always issues. If you haven't had issues, you haven't been in the game long enough. There are issues. There will be issues. But how are you going to manage that? And you need to know what that's going to look like from the LP perspective. So here's a checklist that I found helpful. You want to dive into a lot of these things, but I wanted to give you like a quick snapshot, 5-part checklist on what to do as an LP as you're evaluating these things, right? So like I said, you're going to want to start at the top and find out who's managing the deal. And you may have to dive into the PPM a little bit and the operating agreement to find out really like what the voting rights are, who's controlling the deal, who's signing on the loans. Is there a separate loan guarantor that's becoming part of the GP team by being like a balance sheet guarantor for those loans, right? The next layer down below, the co-GPs, again, what roles are they playing? Is that clearly defined? Who's doing what? You also want to keep in mind, sometimes co-GPs could be added on down the road as well. So it's not like you might open up a deal on day one, and let's say you got a 60 or 90-day window to close. It could be longer depending on the situation. Additional partners could be brought in. And you'll want to know is it's not going to be a significant change to the PPM, because that's presumably already going to be set in stone and signed. But you could have minor changes that don't affect the PPM directly. So you'll want to know what's happening if there are additional co-GPs that come on later, right? We talked a little bit about how profits are structured. Again, they can vary quite a bit, and it's not to say that higher fee deals are bad. That's not necessarily the case at all. Sometimes you got to pay for experience, and it's worthwhile, but you want to know how it's going to be structured. This one, operational experience, critical. You really want to dive into this. I always like to find out from people I'm talking with, explain a deal that went bad and what'd you do about it? What was your most difficult deal you've had to go through? Really spend some time on those types of questions. If if they haven't had a deal that they've had struggled with or a challenge with, they probably haven't been in the market long enough. So anyone who's been in the market, they've had tough deals, and it's not to say to avoid those people. Rather, I would encourage you to actually go towards those people if they've earned some stripes, they've got some battle wounds, like they've been through it, they know. So the fact that people have had capital calls, that's not necessarily a bad thing. It might have been fully market driven, but it's good to know about it. What happened, what was the challenge, what did you do about it, and really dive into their operational experience. This is going to be more critical for the sponsor, right? It's good to know what the other co-GPs are bringing to the table, but they might not have operational experience. Maybe they have a different type of experience that they're doing. So really, you're focusing more on this question is the top part of the structure. And then finally, the decision-making power. Now this is going to be true. The saying, "He who holds the money makes the decisions." There's a lot of truth to that. So if you do have co-GPs that are being brought on as balance sheet guarantors or loan guarantors, they could have some decision-making power, even though they're not maybe being the operator or operational experience there. So you do want to dive into that a little bit more to see what decision-making power they have. I'll also add to this um, on the PPM. You'll want to dive into seeing what percentages of approval that you need to make certain decisions, right? Some decisions will need only manager approval. Some decisions will need, a majority approval from all equity holders. Some decisions will be a supermajority, 66.6% or 75% to make larger decisions, more important decisions, right? So it isn't just a yes or no. This person makes all the decisions and these don't, right? It's never that. It's always a gray scale on who's deciding what. So I would encourage you to dive into the PPM a little bit more to figure out what that looks like for you. So just to kind of summarize some of the red flags here, we talked a little bit about too many co-GPs. You want to keep an eye on that. Co-GPs that are only raising capital and not doing anything else, that could be an issue, along with the SEC, by the way. And then no clear decision-making structure. So on this note, experience, again, we talked a lot about operational experience, and a lot of that is kind of project focused or deal focused, boots on the ground focused. But it's also worth noting that decision-making structure on previous co-GP deals, right? What did that look like? Let's say for a particular sponsor, what did the structure look like beforehand on other deals that you've done? Right. So you don't have to necessarily just only focus on your one deal. You could, when you're doing your experience due diligence on the sponsor, you could also dive into that part of it to see how things have been structured in the past. Like I mentioned, passinvesting.com, we used to work with more co-GPs than we do today. So we've kind of evolved and changed over time, and you'll see that changes happen for different companies, different people over periods, as you can imagine. So let's kind of wrap this thing up for key takeaways. And again, if you do have any questions, drop them in the chat or the Q&A box. And happy to go over that. We're going to have 10 or 15 minutes at the end for questions. So it might seem obvious, but not all GP teams are created equal. It's not clear one way or the other whether you co-GPs are better or worse, right? You really got to dive into it and into the nuances there. Some GP teams can be better if they're working with co-GPs. Some are better if they're not. So it really is team specific. It's not a clear answer here. LPs, again, you want to vet the entire GP team. Go down to that next layer and look at who the other partners are on the team. You want to make sure that you look into those clear roles, right? And make sure you're avoiding that your deal is avoiding any SEC issues with raising capital. Those are 506B, 506C issues that you have with raising capital. And then finally, you want to just make sure you ask the right questions before investing. Now, this is like pretty important on the IR side of things. Investor relations, a big topic, really important role. You want to make sure that you get all your questions answered. And I've been through the ringer personally on this with some investors. You have certain investor types that they want to ask a ton of questions. And then after they ask those questions, they think about it, and then they have a ton more questions. You're really going to want to have an IR person or team who's going to go the distance with you, right? And not, start slow walking you on the answers and start putting you off. Like if you're having issues up front when you're asking your questions, that should definitely be a red flag. They got to be willing to answer all these questions, even though it can be very time consuming for them. That could be a red flag. So at this point, next steps before we get into Q&A. If you did want to join our investor list, we actually just released a new fund this week, our Pick Yield Fund. So you can scan the QR code there for that. Happy to talk to you about it. I know we do have some co-GPs on the call. If you're interested in partnership opportunities, feel free to reach out to me. Happy to talk to you about that. And then finally, follow us on social media, Facebook, LinkedIn, MFIN. You've probably seen that. And these weekly master classes. Whitney is going to have the next master class will be same time, same place, next Tuesday at 3 p.m. Eastern. So at this point, I wanted to open it up for questions. So let's see what we've got in our Q&A. Let's see. Okay. Let's see. Your thoughts on a very experienced multifamily GP that starts a fund one of another property type. I'm not sure the question there, Paul. Maybe you could rephrase that for me. I don't understand the question there. Okay, so why did I join the firm in the first place? Good question. So yeah, I started out in construction in the mid 90s, had a meandering path. I technically a rocket scientist for 7 years with Rocketdyne. I worked on the space shuttle main engines. Then I built a business and up to about 75 employees. And then I started investing in real estate in 2015, sold the business in 2018, and went into real estate full time as a syndicator, running my own deals. I also invested passively in other people's deals, including passiveinvesting.com. And so I've been investing with them for about 5 years now. I'm in four of their deals, and I'd seen a lot of different operators in my roles, and felt that passiveinvesting.com was one of the best operators I've worked with. So when the opportunity came to join them just last year, I jumped on it and was happy to join the team. So it kind of a roundabout way on how I ended up here, but yeah, I started out as an LP, and now I'm full time with the team and managing co-GPs. Funny coincidence that that debt fund I was telling you about, I started investing in it 4 years ago. So I joined the I started investing in the debt fund as an LP, and then now I manage our co-GPs on that debt fund. So kind of funny how sometimes things go full circle, but that's how I ended up here. Okay. Paul, thanks for clarifying the question. For example, an experienced multifamily GP now wants to do RV parks or hotels. Would you wait until they demonstrate success in this new segment? Great question. And GPs and sponsors, they're going to evolve over time for sure. In general, the rule of thumb I like to go by is you can either do a new asset class or a new market, but not both at the same time. So if somebody has a really good experience level, let's say in multifamily in Texas, or let's even narrow it down a little bit, let's just say Dallas. I like to see them doing self-storage in Dallas next, if they're moving into that, whatever, right? They really know the market, but they're going into a new asset class, right? So I don't like to see a particular GP or sponsor do two things new at the same time. The other way they could also do it is by partnering, right? I mean, partnering is huge in this industry, right? They say real estate's a team sport, and it really is. So if they're partnering with other people who have one or two of those expertises, then I think that could also work. But I would look closely at it if it's a single sponsor moving into a new market in a new asset class without outside help. To me, I would double check that. That I'd be nervous about that. Um, when investing in the debt fund, does it put the investor into situations to file multiple state returns? No, it does not. What if you take ownership of the properties with the default debt? Would the answer be different? No, it would not, the way we have it structured. So yeah, for us on that debt fund, we have an LLC that is our operating LLC, if you will, and all of our loans are given out. This is for our hard money lending fund for Southeast US. So people are buying into that LLC or becoming a member of that LLC. So they're instantly diversified across the entire portfolio. Right now, we got about 450 loans outstanding, and they'll get 1K1 from that LLC. Okay, let's see. Any other questions here? All right, last round of questions. I think that's all I have so far. Okay, well, it looks like that's about it. Hope this was helpful for you. Excited to share some things with you. And again, we'll see you next week, same time, same place for Whitney's Masterclass. Thanks so much. Appreciate it, everybody. Bye.